So you just had a kid, or you might even have a few kids, and you're wondering, what is this shiny and new Trump account? And should you open one for your kids? Let's break down why you would or wouldn't and what the alternatives are in today's episode. Welcome, new and returning Money Buddies. I'm your host, Skylar Fleming. Today we're talking all about the upcoming Trump account. What is it? How do you get one? Should you even open one? Why would you not want to open one? Why would you want to open one? And a whole lot more about this seemingly brand new account type. I promise that I'm going to help you feel confident that you're making the right choice to save for your kids' future after today's episode. I'm going to help you with escaping that fear that you're making the wrong choice and that maybe you're putting money into the wrong account. I also have some great tips for new parents stored within this episode, so make sure you stay tuned throughout the entire episode. You're going to be able to take a step back out of the politics of all this and all the news around these accounts and really evaluate the options that you have in order to save for your children. And if you don't have children right now, just wait, don't skip out. This episode is going to be even more powerful for you because you'll be able to figure out a plan to start saving money for your kids before they're even born, which gives you even more opportunity for that compound interest to grow. And who doesn't love some good compound interest? This is going to be one of the biggest advantages for starting early, especially if you just had kids, you're just starting to, or you think you will here soon. And do you want to know how much $1,000 can mean to your kid? What if you were to contribute just $20 a month to that? I'm going to show you within this episode the true power of compound interest and how it can set your kids up to be a millionaire. I'm excited to be your money buddy and guide around this topic when it comes to figuring out how to save money for your kids' future. In my work as a financial planner, I've seen a lot of situations just like yours, and I'm ready to help walk you through your options. So let's get moving into today's episode and see what these fancy Trump accounts are all about. So the real issue as we're getting into this episode is that people are seeing this bright and shiny new account and they're thinking it's a huge deal. Well, really the Trump account, it's just a traditional IRA with a fancy wrapper with a fancy name, and it's making it look like it's a whole lot different. But really, it's going to be an account that may end up locking up the money into retirement and creating a potentially huge tax bill for your kids later down the road if you're not careful. It's just like a traditional IRA where the money is taxed when you withdraw it. So if that money has a really long time to grow, like it does for your kids, that tax bill will end up being very big. And you know who's going to profit greatly from these Trump accounts? The federal government. Because when your kids start taking money out of this account, it's going to lead to high required minimum distributions when they hit their later years of retirement, or it's just going to create a big tax bill. And there is some opportunity to get around this. You've likely heard of Roth conversions. We'll talk about those a little bit more in today's episode, but I want to outline what a Trump account is. How does it work? I want to open up with this article from cbsnews.com. And of course, all these articles that I mentioned will be linked in today's episode, but this is going to be just a quick overview of some of the main frequently asked questions. Who's eligible for a Trump account? Well, parents can open them for children under 18, and those born from 2025 to 2028 can get a $1,000 pilot bonus. How do you open the account? Well, IRS Form 4547, or you can register at trumpaccounts.gov. They'll be opened in May of 2026 with the Treasury, but it does sound like some other brokerages may offer these accounts eventually. What are the contribution rules, or how's the money invested? Well, you can contribute $5,000 per year, and it's invested in an S&P 500 index fund. Another main frequently asked question that we're going to talk about in a lot more detail in today's episode is, should I personally invest in the account? While the article itself states, quote, financial experts advise people considering the account to open up the Trump account to accept the government's $1,000 contribution. Don't just throw all your money into it, though. The reason is because there's other types of savings plans, which I'm going to talk about more here in just a moment. So I agree with the sentiment here. Open the account and get the money that the government is going to give to you. Make sure you take advantage of free money. But this next article that I'm going to cover, it's going to go into more detail, and we're going to start to get into why the Trump account may not be the best option. I have an article here from kitsis.com that says why taxable custodial accounts are better than Trump accounts for kids' savings. This article goes on to talk about how these are basically IRAs for children who don't have jobs. They aren't perfect, of course. They do come with some drawbacks, and there are other options that could work better. The whole game that the government is trying to play with all these different accounts is to give you options that are all so close to similar that if you optimize them the right way, you can come out on top with whichever direction you decide to go. But they're just hoping you just leave them alone. It creates this big tax bill, and then the government gets their money further down the road. They're considering this $1,000 contribution to be money that they're going to make back through taxes way down the road. And they're considering a gift right now when they know they're going to make money on the back end. And to quote this article from kitsis.com, it says problems include many of the same ones as traditional IRAs, including a large required minimum distribution and tax bill in the future, with the potential for the Trump accounts to be funded at a very early age and left to compound and grow for 60 years or more. It's possible that they'll create the very same tax headaches in the future that owners of large traditional IRAs are dealing with today. And this is where a Roth conversion can come into play. A ways down the road, when your child is a young adult themselves, they could do Roth conversions while they're in these lower tax brackets and pay the tax on the money now, and then just like a Roth IRA going forward, it'll be tax-free as they withdraw the money. But the other thing that could be a good idea is a taxable brokerage account. This is just your normal taxable account that acts just like a savings account, except it can be invested in the stock market. They could be a good answer to avoid the tax issues that come with the traditional IRA Trump account. This next quote here says, taxable accounts don't receive tax-deferred treatment on investment income, but that fact could actually turn out to be an advantage because of Kiddie Tax rules, which I'm going to get to more here in just a second. Kiddie Tax rules allow up to $2,700 of qualified dividends and capital gains to be realized tax-free and taxed at the child's tax rate. As a result, a custodial account could have significantly more basis than a Trump account at age 18. And basis, that is the amount of money that you have paid for the investment. And that can mean that a Trump account may end up generating even more taxable income in the future, which may be taxed at a higher rate, as who knows what's going to happen with tax rates, or the person just has more income and therefore they're going to pay a higher tax rate. Kiddie tax is often used as a scary term, but in reality, it's a way to carefully control your tax situation to minimize tax gain for your children. You could use something like capital gain harvesting to continue to raise the basis in that account, meaning the amount that you paid for the investment. You could use capital gain harvesting to increase the basis so that the amount of money that you're making or the unearned income that your child has to pay taxes on through the Kiddie tax rule could be even less and less. I'm not going to go into it in too much more detail, but the article that I'm quoting here from kitsis.com that's linked in the show notes really details the specific numbers about how a taxable brokerage account could come out even better and more tax advantaged than this Trump account after many, many decades of compounding. So be sure to go check out that article if you want to get nerdy with the numbers. And also just schedule a call with me. I'd love to chat about your options. And we're going to get into even more options here, like a 529 account here in a moment with today's case study. But first, I wanted to talk about the Kiddie tax a little bit more. I have an article here from Fidelity that says, understanding the Kiddie tax. The quote here says, the Kiddie tax applies to unearned income. Amounts over $2,700 are taxed at the parent's marginal tax rate. That's the main thing to know. If the unearned income is less than $2,700, which is very likely, then $1,350 of it is tax-free, and the next $1,350 of it is taxed at the child's tax rate. In order to make $2,700 in unearned income, if you were to have a 10% return, you would have to have over $27,000 in the account, which while you're getting started won't necessarily happen unless you just have a large chunk of change to throw into an account, or if there's an inheritance situation. But that's when you should really start talking to a financial professional. And sure, the account could grow, but that's again where capital gains harvesting can come into play and help you raise the basis so that the taxable unearned income is even smaller. I want to share an example real quick here. We're going to call this kid Ben. We're going to say Ben has $5,000 of unearned income that he inherited from his late grandfather. It's on some investments that he has. So that $5,000 is above that $2,700 mark. But fear not, because that first $1,350 is going to be tax-free, and then the next $1,350 will be subject to the kid's tax rate, and then any amount over that will be subject to the parent's marginal tax rate, or the next tax rate they pay on their money as they're making it. So that's just a quick breakdown on how it works. There is the example in the Fidelity article if you wanted to click on that link and read about it a little bit more. But another quote from Fidelity here says, if your child has earned income, you can invest that income up to the limit for the year into a Roth IRA for kids. The same rules apply to a Roth IRA for this age group as for adults. While the money's in a Roth IRA, no taxes are earned because it's in a Roth IRA, and contributions can always be withdrawn tax and penalty free. A Roth IRA can be a goldmine for kids in the future because it's all going to be tax free. So in the same sentence that we were saying the Trump accounts might not be super great because that's going to create a huge tax bill, if your child now has any amount of earned income, it can be a great opportunity to Maybe offer them a household match or a parent match where any earned income they have, you're going to give them a gift of that amount into a Roth IRA for them. And then throughout their entire lifetime, that money is going to be tax-free. And when they withdraw it for retirement, it's all still tax-free. And please, if you want to walk through the potential considerations for your child's tax situation before diving headfirst into opening and contributing to one of these accounts, please reach out. I would love to sit down and just have a quick conversation about options and how they can be a whole lot simpler than they maybe sound at face value. It can be a great way to get them ahead in life and to set them up for a secure retirement. So let me know if you have any questions about this. I'd love to dive into this further with each one of you. But I do have a special bonus here in the episode as we're talking about these investment accounts and these Trump accounts and taxable brokerage accounts. I wanted to just lay the groundwork for new parents and give you some financial tips that I found while I was doing some research for this episode. So I got an article here that says 6 financial planning tips for new parents, and there was 5 of them that I really liked. The article said you should increase your emergency fund, take advantage of tax breaks, start saving for college now, prioritize retirement savings, and update estate planning documents. I do think it's funny that it put saving for college ahead of prioritizing retirement savings, because isn't that kind of the opposite order? But I do think you should put your retirement savings first. The saying goes that your children can get student loans, but you cannot get a retirement loan. But the rest of these we've already talked about in depth on the show. With tax breaks being talked about on today's show, another one to consider is the child tax credits or the child independent care credits. The child tax credit helps families offset costs of raising children, and the child independent care credit specifically assists working parents with the expenses related to childcare while they're at work. But then the other ones that we've already talked about on the show include learning about the emergency fund with episode 16, titled The Complete Emergency Fund Guide for Your 20s and 30s. And then we talked about estate planning all the way back in episode 4. It's titled Estate Planning is Simple and Easy. I have one more article here to share with you called the 10-point checklist for new parents and families. The 10 items go: 1, plan for your first year baby expenses. 2, create or update your household budget. 3, build an emergency fund. 4, understand available tax benefits. 5, obtain proper levels of insurance. 6, start planning for college expenses. 7, prioritize your retirement savings. 8, consider estate planning. 9, consider setting up a custodial account, which is what this episode is all about. And then 10, work with expert advisors as needed. Please be open to working with people who know everything there is to know in these different areas. You don't have to learn all of this yourself. And I'm going to leave you with that checklist so that we can keep this episode under an hour, because if I wanted to go into each of the 10 of those, this would take us a while. So if there's one you want me to dive into a little bit further, leave a comment on YouTube or Spotify or reach out to me, and I'd be happy to chat. And I would love to help any of you with setting up a system around any item on that list. So that does it for this segment of today's episode. Next, we're going to look at a case study which has some very specific questions that I know all of you listening have thought about before when it comes to saving money for your kid. So let's get into today's case study with Alex and Jordan Martinez next. Let's open today's case study by meeting Alex and Jordan Martinez. They're both 28 years old, and their combined household income right now is $95,000. A quick snapshot of their financial situation is that they have about $8,200 remaining in student loans, with a student loan payment of $850 a month. They do have a fully funded emergency fund, so congrats to Alex and Jordan, that's awesome. And they do contribute to their employer match with their company 401k account, which is even more awesome, so great job. That is awesome to see them have an emergency fund, have a plan for paying off their student loans, and be contributing to get the company match. But they do have some money left over after all the taxes and retirement contributions, but they're trying to figure out what to do with it. And this is a perfect scenario to get a financial plan, is to understand where you can plug that next dollar so that you can see an overview of where all your money's going. But the catalyst for Alex and Jordan to really start asking questions about this is that their daughter, Sofia, was born in March 2025. They had been listening to financial podcasts during their late night sessions, taking care of the baby, and they quickly learned the power of compound interest. They did some math and realized just how powerful getting some money into an account for their daughter, Sofia, would be. So they got all excited when they started hearing about these Trump accounts. They got all excited that Sofia was going to qualify for the $1,000 bonus, and they wanted to make sure to take advantage of free money. After all, they were already doing that with their 401k, but they weren't sure if they should be contributing any more money, opening a 529 plan, or if there should be something else entirely that they weren't aware of. They wanted to make sure that their daughter had options, whether it was college, trade school, maybe she wanted to start her own business when she became an adult. They just don't know how much they can actually afford to save for her right now, especially with their student loans still hanging, although they're almost gone, but they are still hanging over Alex and Jordan. And then Alex added they also were worried about overdoing it. They didn't want to save a ton of money for her college, and then she gets a full scholarship. Or they couldn't save for their retirement, or maybe their daughter didn't go to college at all. They wanted flexibility, which is what financial planning is all about. They wanted to make sure that whatever happened and whatever they decided to do with their money, that they were going to be able to make a difference in their daughter's life and set her up financially. They had 4 questions for me that we're going to talk about here in just a second. 1, should they contribute their own money to the Trump account beyond the $1,000 bonus? 2, how much should they realistically be saving for Sofia each month? 3, where should they put that money to balance college savings with flexibility? And 4, should they wait until their student loans are paid off in about 10 months before starting? So what's my overall take on the situation? Well, their situation sounds pretty stable, which is great. They're contributing their own retirement, and as long as they're on pace for a retirement that they can enjoy in a timeline that they would like, then great. Let's do other things with the extra money beyond that. And that's when we start looking at things like saving money for your kids. If your budget's still going crazy or you're not saving for retirement, let's pause this discussion and let's start there and detour back around to saving for your own retirement. It's important to make sure you're saving for your own retirement first. And since we're all still young and time is still on our side, it may not have to be a whole lot every single month. You're in a great position to start saving for your own retirement as well. So let's have a chat about this if you want to get started before saving for your kids' future. But let's get back to Alex and Jordan's questions, with their first one being, should they contribute their own money to the Trump account beyond the $1,000 bonus? I don't think they should, at least not right away. Further conversations should be had about the direction that they want this money to go, and I'm going to help lighten the path a little bit more on where they could put this money and some of the other options. But if they wanted to set up money to set their daughter up for retirement, then sure, this could be a good avenue to go. But if they wanted to focus on education, there could be other options. But no matter what, open the account to get the bonus, whether it's the $1,000 bonus or the $250 bonus. Get the free money. The second question they had is, where should they put the money to balance college savings and flexibility? Like we talked about with today's episode, a taxable brokerage account can still grow and the gains can be used at any point. There will be tax consequences, of course, and that always bears mentioning. But you could always use a taxable account for college payments and still have flexibility to use the money however else you would like to. Or there's always a 529, which brings up their college savings question. What if your child gets a scholarship? Well, there will be no penalty on withdrawing funds from a 529 equal to the amount of the scholarship that they receive. There will still be taxes because the money's not being used for education expenses, but avoiding the penalty makes this situation just fine. It honestly makes that 529 like a taxable brokerage account. So if flexibility is your biggest key factor in all this, a taxable brokerage account might be the right place to go for saving for your kid's future. But the next question that they asked is, how much should they realistically be saving for Sofia each month? Start small. Start small right now with $25 or $50 a month, and don't stress yourself out. You still have to live life and save for your own goals, but guess what? $25 is going to be a huge deal. I'm going to show you a little bit later in today's episode exactly what $100 a month can do when it comes to these Trump accounts and adding on to that $1,000 bonus. So please don't feel like you have to go out and put $500 a month into a retirement account for your kid. I know that you want to be the best parents and set your kids up for success, but listen, you also know the value in having to work for your own success and providing for yourself. You can always pause or turn down the contributions for your kid's future, or you can turn them up if more money comes into the picture. Again, that's the value of this whole financial plan. You just know where to plug the extra money into. But that leads us into our last question of what to do with this extra money. Should they put it towards their student loans? They asked, should they wait until their student loans are paid off before starting? I don't think this is a bad idea at all. Honestly, they have a timeline for it. They can come back around to this question. They could start with something small now and then also come back around to this question. But knowing that the student loans are paid off will free up some more extra cash that they could decide to put towards saving for their daughter. It's not a bad idea if you want to wait on some things and let things settle down. It's just important to make sure you set some sort of a reminder or set a timeline on actually coming back around to the topic. Don't use this as an excuse to procrastinate an important decision. Because if we try to do too much at once, we'll find ourselves wanting to do nothing at all, or just feeling restricted by our financial plan and our budget. But like I said, it's likely you can start doing something small now. Start with $10, $15, $20 a month. And then once the debt is paid off, you could revisit the amount and crank up the cash flow and start pouring even more money into this account for your daughter or son, whoever you're trying to save money for. Start small now and then consider, what milestones might you be hitting soon that could allow you to increase the cash flow. That way you can at least say you're getting something started and you can get the stress off of your backs. So whether it's a Trump account, a Roth IRA because your kid has some earned income, or it's just a custodial taxable brokerage account for your kid, just start saving small if that's what you want to do, and then set some milestones to check in on when you can crank up that cash flow. And that does it for today's episode. We did it. We learned all about the Trump accounts today together. And I was honestly quite surprised in my research to learn that they're not just a perfect account that you should be throwing all your money into. I was really excited to learn about how the custodial taxable brokerage account can be such a powerful savings tool for your kid. But I do want to wrap up this episode, and I'm going to tell you a little bit about next week's episode. Hint, you're not going to want to miss it. The one action item from today's episode is to schedule a call with me to discuss your options for saving for your kids. There's a link at the top of the show notes of this episode to schedule a quick call with me. I would love to chat more about this with each and every one of you listening. But I did promise you that I would show you the true compound interest for kids. So let's get into that math. But first, I need you to share this episode. Do you know someone with young kids or someone who just had a baby? Send them this episode so that they can get some great information around the Trump account and around how they can make a decision to make their kid a millionaire. And just how can you make your kid a millionaire? Let's talk about the amazing math that's behind this superpower known as compound interest. How much does that $1,000 gift turn into if you were to open a Trump account today? Well, $1,000 after 60 years of a 10% average return compounded annually turns into $304,000. Now get this, if you were to add just $20 per month to that account, it would end up being over $1 million. It's all because of that superpower of compound interest. So please, let's have a conversation today because the math of compound interest can be so hard to comprehend. So let's sit down and talk about your options for saving for your kids together. Go to the show notes and right at the top, click on the link to schedule a time to chat with me, and let's talk about how we can set up your kid to be a millionaire pretty easily. But next week, we got another great episode lined up for you. Guess what? It's tax time. How exciting. I'm pumped. I don't know about you, but I'm super excited. I know you might not be getting as excited about taxes as I do, but it's time to start prepping to file your taxes and start planning for 2026. So next week, we're going to run through what you need to prepare for tax season so that you can make it a true piece of cake this year. Thank you for listening to this week's episode of Financial Planning for Young Adults. I'm your host, Skylar Fleming. Have a great week. And hey, quick heads up. This podcast, it's meant to be educational and it's for entertainment purposes. It's not personalized financial advice for your specific situation. So before you go out and make any big money moves, make sure you chat with a qualified financial professional who knows your full financial picture.